This is CC. Welcome back to the Orbit. It is Monday, November 13th. Futures are slightly lower following the rally on Friday. That rally on Friday saved the week a little bit to the upside. The market was sort of choppy, was actually down slightly, and then with that rally on Friday, it closed up about 1.2%, which was about in line with the expected move. Now, we've been talking on the Orbit lately about low volatility. The VIX is 14 or so. And as you're about to see, that means some pretty tight expected moves. We're looking at today's expected move in SPY. It's a little more than 0.5%. And then if we're looking out towards the end of the week, we get about a 1.1, 1.2% expected move. So that is on the tight side. But as you see last week, that move that felt very strong to the upside, especially Friday, actually ended up only being a 1.2% move on the week. So it was about what options were pricing. However, that does not change the fact that, as we've been talking recently, if you are doing income from option trades, let's look at like a condor for today, that it is tight strikes. And sometimes that means you might want to explore perhaps going a little bit wider. In this case, if that was risking 75 to make 25, that may give you a little bit extra room. You just have to be careful. And then we talk about those, perhaps legging in and out. Like today, the market is lower. Perhaps you start with a credit put spread, see if the market goes back to unchanged, and then potentially do the credit call spread side. Or, in this low vol environment, they tend to be slow grinds higher. It's the conditions right for a slow grind higher into year end. That does not, of course, mean that it is up every day. There will, even in those conditions, there will be red days. If those red days pile up and stack up, then that turns into a sell-off, and then you're going to see vol pop. But if those down days get bought and you see more green days than red days, that's a low vol, slow grind higher. And in that case, starting with credit put spreads, being very careful to the upside on the credit call spreads, covered calls, things like that. In a slow grind higher, I think most people, most traders find themselves getting taken out to the upside because those strikes that they are selling are so close to the money. So you have to be kind of careful here. The low vol means that you are less likely to see big moves day to day. But again, in low vol with narrower expected moves, the chances of it barely getting through the expected move are higher than if you saw a VIX at 22 or so. Checking in on the Qs, we've got about a 0.6, 0.7% somewhere in there, 0 DT expected move this week. Now, a reminder, we have CPI this week, we have retail sales, we have a couple of the big retail earnings. When you're looking at the vol across the market, you actually do see that it is higher vol this week and starts to go down into year end. You can see it sort of right here with the Qs. We're seeing 17, 18 into December. The same thing is true of SPY and SPX. When you look at that, it's this week's vol is 14, 15, and then as you go out to year end, it's more like 12, 13, which makes sense. We've got the holidays, earnings season will be over. We're getting the economic data. The CPI this week is sort of finishing off the story of the last couple of weeks between the Fed and inflation, and we're going to have a pretty good sense of what's going on in the market. And then producer price index also comes out this week. The Qs, we've got, let's just look at the iron condor for this week, actually. Let's go out to the 17th. Let's look at this. And we have got short strikes of 375 and 384. As you can see with the stock 378, how tight those are. Again, explore, if this is your strategy, explore the risk reward of going out a little bit wider. Let's just look at how 0GTE on the same front. This is down 0.3% this morning. So if we were looking at, say, let's do a bullish, we'll go to the out of the money credit put spread. Let's just look at this right here. Yeah, it's about risking 80 to make 20, a little bit worse than that, actually, under 20. So this is, again, something you'd want to explore here. Do you take the whole trade? Do you move it down a little bit? Now you're talking about something very, the picking up pennies off the train track. So this is just, when you're using options AI, this is the great thing about this visual trading is, you can sit here, you can move these trades around, you can get a sense of that risk reward instantly. It's making an instant calculation. Of course, the market is down, and these strikes and these prices are based on Friday. So this lower, what we're looking at is the risking 90 to make 10-ish. That is on the open. That is actually going to be closer to 80-20 because it will start a strike lower on the open. So that's what I'm talking about with like the sort of legging into income trades.